Welcome to the daily insights that matter. The last few days have been very complicated for Indian investors like you and me. It has been choppy, and yesterday alone the Indian markets plunged about 1.5% with all sectors in red. Sensex now trades below the psychological level of 60,000 whereas Nifty below 17,600. Are you worried about the market plunge? Do watch this video as we list down the factors that caused the volatility in the markets. So what's causing the volatility in the markets? Let me list out the factors for you first. Number one was the anticipated hawkish comments from both the RBI MPC and the Fed meeting minutes. Second were the developments around the ongoing Russia-Ukraine crisis. And third was the Adani Group saga. So let's begin and discuss this in detail. The first one being the release of the RBI minutes. In the MPC meeting on 8th February, RBI had raised the repo rate by 25 basis points, taking the rate to 6.5% to contain inflation. While inflation eased in the months of November and December, CPI inflation went up to 6.5% in January, above the tolerance limit of 6%. Till date, the members have raised 250 basis points to tackle the ongoing inflation. The minutes which were released yesterday showed that inflation still remains a concern, and the RBI will give time for the past policy actions to work through the system and hence continue with the stance of a withdrawal of accommodation. There is extreme uncertainty, and therefore the RBI will monitor every incoming information and data, thereby acting appropriately, being mindful of growth. The second factor was the release of the Fed minutes. The markets around the globe keenly wait for how the world's most developed economy hints on further monetary policy tightening. In the FOMC meeting conducted on 1st February, it was unanimously agreed to raise the benchmark rate by 25 basis points. After going on a spree of jumbo-sized rate hikes by 75 basis points in the year 2022, they have adopted a slower pace of rate hikes. Currently, the Fed interest rate stands at 4.75%. The economic data in the US points to a growing economy amid a tight labor market. The Fed is on a long-term goal to curb inflation below its 2% target, for which it intends to further increase borrowing costs to cool down inflation. The members noted a tightening policy stance would be ideal to control inflation. Another factor was the recent development of Putin's nuclear warning. The ongoing tensions between Russia and Ukraine have been intensifying. It has been exactly a year since Russia invaded Ukraine, and the war still remains. On Tuesday, Russian President Putin gave a warning to the West and threatened to resume nuclear tests. He also suspended a crucial nuclear arms control treaty that was signed way back in 2010 that limited the number of strategic nuclear warheads a country can deploy. Lastly, the news around the Adani Group. It has been the talk of the town, with Adani being in the news after the recent report from US short seller Hindenburg. The Adani Group's market cap has fallen by around 142 billion since Jan 24th. With this saga, India has fallen to the 7th rank in the list of nations by market cap. This news also spooked the markets. So far, the new year has been a mixed bag. While domestic economic data seems strong, inflation remains a concern, which follows rate hikes that slow the economy. The geopolitical issues and the impact of monetary policy tightening by central banks around the world has given rise to global recessionary fears. On the back of this, the Indian stock market, outperforming global peers in 2022, has been volatile. As investors, of course, we would be worried about the future trajectory of the markets. But do know that despite such obstacles, India is projected to grow at 6.8% in fiscal year 23. This is the fastest growth rate for any large economy. We've spoken multiple times about how various policy initiatives will propel India to be a leader in this decade. And this should be our main takeaway as long-term investors. Of course, in the short term, we will face headwinds. In times like these, it is best to stick with the good old investment principle. Focus on quality companies whose fundamentals are appropriate to current macroeconomic conditions. diversification of portfolio with different asset classes, and adjusting your risk level. Also, a key point for you to remember is that the Indian growth story is still very intact. If you're still worried, my colleague Raj will speak on these topics in greater detail in the Third Umpire video, which will be released this week. So what does this news mean for you? India is expected to retain its tag as one of the fastest growing economies in the world. The underlying fundamentals and growth prospects of India are strong, and short-term headwinds will have a minor impact on the country's long-term outlook. This will have a direct neutral impact on you. While I say this is me, Rahil Hassan, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.